you and I have been talking about is that I think there's a lot less room for the Fed to hike rates. And what the Fed's really hoping for, to your point, is that the economy and the markets are going to do the work for the Fed, so they don't have to hike as much. They're wanting the stock market to come down. They want the housing market to come down. They want the economy to slow down, which will quell inflation. So they're okay with letting that happen for now because it's all been pretty controlled up to this point. When it gets uncontrolled, that's going to be where they really run into a problem.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart here. Welcoming you back for another weekly market recap after a emotional roller coaster of a week. Lance Roberts is here with me as always. Lance, great to see you, buddy.
Good. I don't know if you can see my background, but this is one of those Zoom backgrounds because I'm actually on the bridge right now. So we'll just.
Well, I made that joke when you and I got on before we started recording. And look, I mean, I was all prepared. I had the scotch here for you. I had the glasses for us just to really get you decompressed. Yeah. But you reminded me that we're basically up for the week, believe it or not. I think most people hearing that, it's probably a shock. But when you look at where we started this week versus where we closed, we're actually up a little bit, aren't we?
It is. And this is the important thing to really talk about. And again, we kind of let our emotions, kind of drag us around a good bit. And, and it certainly, look, don't mistake what I'm saying here. Markets are flirting with the lows. We're sitting on really critical support. The market's been able to hold that so far. Things don't look great by any stretch of the imagination. But if you kind of looked at the markets over the last 2 days, it seems like it's like, oh my gosh, the wheels just came off the cart. Read the headlines, and don't forget we had probably one of the best bottom tick indicators, which was yesterday. CNBC ran their markets in turmoil, special on CNBC. That pretty much always nails a bottom. Returns. Charlie Biello over at Compound Advisors did a chart of every time that CNBC runs their markets in turmoil, and that's almost every time that's a market bottom, you have positive returns over the next period. So, we got to just be careful. And I want to go back. Look, I've had tons of conversations with our clients. We've had, just a lot of emails and phone calls. And look, hey, I get it, right? There's so many bearish headwinds out there. We've got the Fed hiking rates. You've got inflation. You've got the weak economic data that just printed in the first quarter. I mean, we can make a very bearish case of why this market's going to just keep going down and not ever turn around again. And that's certainly something worth considering. I'm not discounting any of those negative biases that not biases. That's a wrong word. Those negative metrics that are, fundamentally sitting behind the economy and the markets, not discounting those at all. But when you have a tremendous amount of negativity, and particularly when investors become extremely negative, and we have the most negative sentiment of investors, both professional and retail investors, at any point of a bear market low in history, going back to like the 1970s. So we just have a collision of things that suggest, and this is the thing that, it just is always important to consider. And I'm actually writing this in this weekend's newsletter. So if you want to read it, you can go to realinvestmentadvice.com and subscribe, and I'll email it to you on Saturday. But what I'm writing about right now is, this idea that when you have a lot of negative sentiment, it doesn't mean that your fundamental outlook is wrong. It just means that the markets have a tendency to have pretty significant reflexive rallies. And that rally is going to start to lead CNBC from markets in turmoil to why the bear market is over, and it won't be. So you'll definitely want to use that rally to rebalance risk. And particularly if you're offsides right now under a lot of pressure, I'm seeing a lot of portfolios that are coming in for review that, they're 100% equities, and they're stocks that, are still kind of hanging over from the 2021 kind of meme stock phenomenon. So use this rally to start clearing out of some of those positions. We've used the gardening analogy before, kind of prepping the soil for what's going to come next. And it doesn't mean that everything's going to work out perfectly okay. But generally, when you start to emotionally panic sell markets, that's generally exactly the wrong time you want to do it.
All right, great reminder. We've talked in previous videos here about our emotions. For the retail investor, our own emotions are usually our biggest enemy to our long-term investing success here. So good reminder here that as emotions are high here, we're much more likely to be kind of driven by the lower part of our brainstem here and not by our higher functioning.
It's actually, Adam, it's lower than that. And it's generally when it's all puckered up. That's when we start.
You're out of the brain and way lower in the body.
Exactly.
Great point. Well, look, I do want to dig into this a little bit. I don't mean to make light of this because I think a lot of people watching this, I'll be kind and say we're nervous this week. I think some of them may have been much more so, and for very understandable reasons. Yeah. So real quick, I'll toss out my theme for the week. You can put your own in as well, but mine is a whole lot of shaking going on. We moved all over the place, but again, we pretty much ended where we began largely. That said, I'm going to ask a couple of questions, even though you just sort of stated what your general perspective here. I want to ask some questions that I think some people watching would love to have answered.
Sure.
So the first is, we've now had several weeks of kind of failed attempts to rally here, right? Where we're middle of the week, we have some sort of big buildup and then we lose it by the end of the week. They've kind of been these mountain-shaped weeks that we've had for the past several ones. This one was pretty extreme. Wednesday had a face ripper rally, and everybody thought, all right, that's it, that's the bottom, right? And classic bull trap. People, jump back in long, thinking I'm going to catch the bottom here. I'm going to ride this bounce, and then they equally got their faces ripped off, on the way down. And every rally over the past 48 hours has failed. Today the market struggled and got back green a couple of times after opening down pretty substantially, but it just couldn't keep it, right? And so first off, are those failed rallies anything that you're worried about here?
Oh, absolutely. And look, it's not just failed rallies over this week. It's been failed rallies ever since the beginning of the year. Let's talk about the negative slope of the market, which is very important. The market's in a very negative trend ever since the January peak. There's a defined set of market tops and a defined set of market lows. And this market has been trending negatively. There is also, I'm going to throw out a term here and everybody's going to go, oh yeah, I see that. You got to be really careful with this because, there's a lot of when you're looking at chart patterns, it's easy to make pink fuzzy muckings out of just about anything in the market. But there is a fairly defined head and shoulders pattern with a sloping neckline that intersects with about 4,000, 4050 on the S&P right now. So, a fail of that break line, and I would just use the nice round number of 4,000 because the markets are really looking at that level. So, a break of 4,000 certainly suggests that markets could fall, closer to 3,500, maybe even 3,000. And that's kind of hard to fathom here, another 1,000 points after we've already done a lot of damage to the markets. Again, if you look at, as we talked about, I think last week, you take a look at a lot of the market, right? And, we did the study of market cap above $7 billion and looking at the just hundreds of companies that are down 20, 30, 40, 50, 60, 70%. There's been a really big bear market that's been going on now, really since the beginning of this year, really, and going back into to 2021. But yet markets have pretty much, done nothing. And here's kind of another takeaway from this is that, this year seems terrible. And this is also part of what I'm writing about in this weekend's newsletter. So we've had a 14% drawdown of the market at the low point yesterday. And, that seems awful. But this is coming off a 26% advance that we had in 2021 and another big advance you had in 2020. So you're up 120% from the March 2020 lows. You're down 14% from the peak. And we had warned you, not here on the show, unfortunately, because you weren't doing this show back then, but in our newsletter and our commentary and our radio show and our podcast and things that we do on our website, we were warning you. We said, hey, look, we've had a year where you have no volatility. The worst drawdown in 2021 was a 5% drawdown. It was a buy the dip mantra. Every time the markets dipped to the 50-day, you bought it, markets ran back up. And it was super easy to be long equity. And I said that when we got a normal average correction, it was going to feel a lot worse than it actually is. And that's exactly what's going on. 14% down this year is the average drawdown of the markets in any given year going back to 1960. So, put it now, does that mean that some years are bigger drawdowns? Absolutely, right? That's what averages are. Some are more, some are less, but on average, 10, 11, 12, 13% drawdown in any year is about normal. You should kind of expect going into a year that at some point during the year, you're going to have the 10% drawdown and the market's going to recover and go back up. So it's important. And again, what I'm trying to get across is that it's about perspective, and it's important to keep perspective, because where we are right now, this is where investors make all their investment mistakes. This is where investors sell low. And of course, they were buying high last year. Now they're going to sell low and completely destroy their portfolio. This is the time to just step back for a second, evaluate the risk in your portfolio, and say, what am I doing here? And what am I trying to achieve? And then rebalance that portfolio accordingly to start helping you get towards your goals. And again, we're seeing a lot of people coming in right now with portfolios that are all over the place. They're all long gold and commodities, or they're all long tech stocks, or whatever it is. And we've talked about the risk of one-sided trades. And if Adam, we'll talk about this in a minute, but if Adam and I have been talking about the last couple of weeks, we may have seen the peak of inflation. That doesn't necessarily bode well for commodity type stocks. So, you want to be careful being on the wrong side of that trade if inflation starts to show some disinflationary pressures later this year. So this is the part about, managing risk and understanding where you are, and not allowing your emotions of what, we think is going to happen drive our portfolio decisions. I just wrote an article that I'm working on right now, and one of the quotes I've got in there is from Howard Marks, from Oak Tree Capital. And he says, his quote says that throughout all of history, the worst of outcomes rarely happen. More often than not, the worst of outcomes are the best buying opportunities. And his point is that we tend to get into a position to where we think the world's about to end. And when we get into that position, and it's like the economy is going to crash, the whole world's going to be over, that's probably the time you want to start buying assets, because generally that's about the time that you're getting assets at the right prices.
Yeah. You're making a good case there for cash too, to have some cash on hand to be able to deploy in those times.
Yeah, absolutely.
And that goes, that echoes the whole Buffett, be fearful when others are greedy, and greedy when others are fearful. And we've talked a little bit about this, which is, it doesn't have to be the absolute worst case scenario ever to be a good buying opportunity. A lot of what you do as a professional financial advisor is sort of look at the cycles, both long-term and short-term. And we've been talking about some of the shorter term plays that are investments that you've been making, expecting there to be a reversal of trend, right? We've talked about how it can be really hard to press the buy button, because you're fighting the trend, right? Exactly. And at the maximum opportunity, it probably feels the maximum worst to press that buy button, right? So I'm not encouraging people to take unnecessary risks, but I'm just saying that to be an investor, oftentimes you want to be buying when the herd is not, and that can feel lonely and scary at times.
Well, it's a great point, Adam, that you bring up, and it was something that Mike Leibowitz, my co-portfolio manager, and I were talking about yesterday. We've talked about two things on the show here, and let's just use two really good examples here. The first is NVIDIA. So AMD just came out, blew away earnings just this past week. Stock had a nice pop based on those earnings. Despite the fact that everybody thought the world's slowing down and couldn't get chips for anything, etc. AMD just killed it on their earnings, and revenue outlook was good also. NVIDIA is coming up to report, and NVIDIA is right in the center of that whole, everything from graphics cards to video games to, everything that we do in virtual reality and artificial intelligence. I mean, where the world's going, that's where NVIDIA is. And look, the stock's expensive, no doubt about this. But here's my point about it. The stock's been under a tremendous amount of pressure. If you could buy the stock today and put it away and not look at it for 5 years, you're probably going to make a good bit of money on it. All right. Another stock that I absolutely hate, same case, is probably Facebook. But the problem is that, as we've talked about before, we're constantly glued to our portfolio every minute of every day. What's up, what's down, what's going on, and blinking red lights and green lights. And oh my God, let me ask you a question. If your investing time horizon is 10 or 15 years and you're buying good quality companies at good prices, what does it matter what the stock market did today or tomorrow or next week, right? We're all wrapped up into what's happening in headlines, and we're forgetting what our portfolio is supposed to be doing over time and what we're paying for assets and what we're entering into in terms of a longer term perspective. Now, I'm not promoting buy and hold here. That's not what I'm saying at all. What I'm talking about is investing and buying stocks at cheap valuations, or buying companies that have a position in the markets that have been beaten down a lot, that have some opportunity. And it doesn't mean go load up your entire portfolio on these things either, but there's buying opportunities. And we've talked about how to enter into a position, how to start building a position. If a portfolio sizing and your portfolio is a 5% weight, you buy 1% now. And if the stock goes down some more, guess what? That's awesome. I'll buy another 1%. As long as my thesis holds, as long as fundamentals remain, as long as technical trends remain in place, and the stock is performing as I expect it to, I can invest in things and weather, market turmoil in the short term. Now, look, there are certainly cases where you've got to change that decision. Peloton's a good example, right? I mean, this is a company that everybody thought was going to dominate the world in making standing coat racks for homes. And, the reality is that that wasn't ever going to be the case. And that was it was a flawed business model. It was a flawed business strategy. Some analysis would have told you that, but, the stock began to reflect the real value of that company. And it was certainly a time to exit that strategy. And that's where you say, look, my strategy was wrong. What I thought was going to happen was incorrect. And that's where risk management comes in. But that's not dictated by a 1-day move or a 2-day move or 1 month move, right? This is stuff that takes time to flesh out and to determine. And that's part of the investing process. The problem today is we're so short term, every moment of every day, we're looking at what every single thing in the portfolio is doing. And we forget about what the portfolio is doing. And Adam, you and I have used the engine and the car. So, we've used a ton of analogies, right? But, we forget about what the engine is doing and how is my engine performing relative to what my goals are, not these individual specific issues. Now, look, again, I want to be clear. I'm not promoting buy and hold, and I'm not saying just ignore things that are going wrong in your portfolio. You've got to manage those risks, but don't lose sight of what your goals and objectives are on these, weekly turmoils. And again, this week is a great example. It was like, my God, my portfolio just blew out the back end over the last 2 days. I'm losing all kinds of money. Well, not really. You're about where you were at the beginning of the week. So, what really changed over the course of this week? Nothing. In fact, you're about where you were last week too. So over the last 2 weeks, markets have gone up and down a whole lot. It's been a hell of a ride. It's been absolutely one heck of a stock market roller coaster. But at the end of the day, we haven't gone anywhere. We've just made a big loop around the track and are back where we started. The question will be now, what happens as we go ahead?
All right. And I want to get into that with you. And I also want to get into a number of sort of still outstanding risks. We got to talk about the recent Fed meeting. We got to talk about inflation. We got to talk about housing. We got to talk about margin calls. Yep. Then we're going to talk about what are you guys doing right now for what you see coming. But before that, I want to pull a conversation I was planning on having later in this conversation up up to the forefront now because you just addressed it. So I was talking to John Penn, fellow at your organization, who, when people fill out the form for Wealthion and want to talk to you, he's the guy who actually does, the onboarding for them. And he's on the front lines, talking to all these people that are calling in, and he's a great sort of, finger on the pulse of the customer for me. And so he comes back to me and tells me, hey, this is what I'm hearing from folks. And one thing he said recently was he's definitely seeing a lot of anxiety around people who have this strong pressure to keep pace or to beat the market, right? And he just said, hey, you and I want to talk about this for a moment, and let's do so. And I want to go back to the car analogy, the engine analogy you mentioned earlier. So when you're going somewhere, when you get in your car to go somewhere, what are you really counting on? Well, you're counting on your car to get you where you want to go by the time you need to be there, right? Then at the end of the day, it doesn't matter if you're the first one there, the last one there, whatever. It doesn't matter how fast the cars on the highway drive or how fast you're driving relative to them. All you really care about is, am I getting where I want to go by the time I need to get there, right? And I think investing is, you want to have a similar mindset when you put together your portfolio strategy, when you think about your investment portfolio, which is, I just need to get I need this to get me to meet my goals by the time in life I want to meet them. And if you put the added stress on you of, I need to be beating the market this year, this month, this week, that's when the emotions creep in. And that's when the doubt creeps in and you start saying, well, Jesus, I got to sell this company because it's gone down today, or this one's, I'm not in and it's taking off, so I need to jump into that. You obviously are on the front lines of this, Lance, so I'll let you jump in here. But is this the right way to be sort of telling people to kind of maybe reframe how they think about all this?
Yeah, it's actually a great example. Let's say that Adam, I'm going to fly out to your house in California, and you and I are going to jump in a car, and we're going to drive to Las Vegas. Okay, we're going to go have a boys' weekend in Las Vegas. My wife will never agree to this, but we're going to have a boys' weekend in Vegas. Yours won't either, I know.
Yeah, mine neither.
But we have two ways to get to Vegas, right? In your car, we can drive super fast and get there pretty quick, right? The other option is that we can drive safely. We won't get there as quick, but we'll get there. So we have two options. So let's drive as fast as we possibly can. This is the analogy of trying to beat a random benchmark index to get to our goals. Now, we may get there safely and everything may be just fine. But if I'm driving really, really fast, and I'm not talking about driving 10 miles over the speed limit. Adam, what kind of car are you driving?
We're in Cannonball Run. I get it.
Yeah. So we've got your Volkswagen and we're doing 120.
I'm not sure it can do more than 105, but anyways.
You get the idea. So, we're in the Scooby-Doo van, we're going as fast as we can. We have a blowout, we bust a radiator, whatever happens, right? But the potential for an accident is greatly elevated. And the potential, if we do have an accident, for instance, let's just say we have a blowout, the damage that results from a blowout at a very high rate of speed is much potentially, keeps us from ever reaching our destination, right? That's really the point. So when I'm trying to beat some random benchmark index for one day, 1 week, 1 month, 1 year, I'm going to have problems along the way. And the faster I'm trying to drive to get to my goal, the bigger the accident is going to be. Because if I'm driving the speed limit, Adam, you and I were back in the Scooby-Doo van, we're going to Las Vegas, and we have a blowout, but we're driving the speed limit. Yeah, we have to slow down. We pull over, we lose half an hour or so changing out the tire, and we get back on the road and we go on and get to our destination. Yeah, it's not nearly as exciting. And, sure, we had a delay. And that's the point here, is that if I'm just managing my portfolio, let me give you a good example. 60-40 allocations this year are negative. Now, the market's down about 14%, and I haven't checked the benchmark lately, but I'm probably going to assume the 60-40 right now is down probably 9-10% for the year. So it's not down as much as the market, but our portfolios, because of where we're carrying our weight, we have about 30% in cash, and we have our fixed income, and we have our equities. We're running about a 500 basis point lead over that index. So yeah, we're still traveling along with the index, but we're in a position that if the market really crashes or if something really happens, we're still okay. We can pull over here. We're taking, we've got a little bit of a delay towards our financial goals. We've got a little bit of a flat tire right now, but we're going to be able to quickly fix the automobile, get the car back on the road, and get to our goals rather than trying to make up some catastrophic problem that occurred from trying to drive too fast. And that's really kind of the frame that you take as an investor. Look, not every year is going to be a positive return. Not every week, every month, every day is going to be a positive return. You cannot invest in the markets and not have volatility in your portfolio. You're going to have years, months, weeks, whatever it is, where you're going to have a negative return in your portfolio. That's completely okay. There's nothing wrong with that, as long as the structure is in place that over time, your money will grow with the markets. Trying to avoid losses, this is what we call psychologically as loss aversion. If you try to avoid all losses, you're going to wind up creating more trouble for your portfolio than actually just riding a market crash out through it and back to recovery, because of all the psychological problems that will come involved with, trying to get out of the market and get back in. And we talked about these issues on the show here before, Adam, about people who've been out of the market since 2009. The point of investing is to build a structure, build a car that'll get you to where you want to go safely. But that doesn't mean that along the way, you're not going to have a few delays. And there's nothing wrong with that at all.
All right, great. And look, I think we could spend even more time on this, really hammering the point home. But I think both I want to get back to sort of some of the news of the day, but also, we're spending this much time, folks, because, as Lance, you were saying, you're beginning to really hear people, pick up the phone and talk to you with the emotion in their voice. And the general message here to folks is, take a breath. Don't let the emotions drive you. Work your plan. If you don't have a plan, put one in place. If you want help, work with a professional financial advisor to do that. But don't let the emotional charge of the moment force you to make bad decisions at this point. Yep. All right, Lance. I want to get back to a couple of key things that I'm sure are on people's minds, and let's just start with your reaction to the Fed. Right. So we had Powell get in front of the cameras the other day. He said a couple of things that were interesting to me. I mean, one, he confirmed that the Fed was going to hike rates by 50 basis points. It made people feel like, yeah, that's probably going to happen again at the next meeting. But he said two things that really stuck with me. One was, he said, hey, we're super serious about controlling the demand, and harped on it enough and dodged enough pointed questions during the Q&A that I kind of took from that. He was saying, like, yeah, I'm actually kind of willing to sacrifice the market and the economy a bit to bring inflation down. Again, how long is he going to be able to maintain his backbone there? We don't know. We've talked about that in the past. But he did seem to be saying a little bit like, trust me on this, guys, I'm going to be serious. But the other thing he mentioned that I thought was refreshing, I guess, but he admitted several times, we have no control over the supply side, right? So people were asking him questions about, all right, what's happening with, commodity prices going up because of supply chain breakages or Russian embargo and stuff like that. And he basically just sort of shrugged and said, it's out of my hands. And so, I've just rarely seen the Fed be so openly admissive of its powerlessness, but that is completely true. And that's a really important point for us to keep in mind as we go forward from here. Is there are factors, they're not driving all trends in the world right now, but there are big factors driving a number of trends here that the Fed has absolutely no control over here. So it's not all in the Fed's hands.
Yeah, no, that's a great point. I mean, there's some things happening, like you said, that the Fed can't control, and let's just be honest, the Fed can't control anything. It's absolute hubris that the Fed even thinks they can control employment or price stability or anything else. They've been terrible at that job for the last 40 years, so I don't know why anybody ever expects them to get it right this time. But hey, we keep. I guess we try to get enough. Maybe one day they'll get lucky. But yeah, two things that he said I thought was interesting. One is that they're not even considering 75 basis point rate hikes. So only going to do 50 basis point hikes. And, you know,
Sorry to interrupt, but a
yeah.
lot of people think that that's what caused the huge spike on Wednesday, right?
No, that was part of it. The other side of it, the conversation about not considering 75 basis point hikes, yes, that was the big kind of momentary spike we had in the markets. But it was also the fact they're tapering their balance sheet slower than was previously expected. They're going to start at 47.5 billion and go to 90 billion in 3 months, 95 billion, I'm sorry, in 3 months, and they'll stay there. Now, here's the interesting, I ran a chart for this weekend's newsletter that shows the Fed balance sheet. And if you run that taper on their balance sheet, they will only reduce the balance sheet to $7.5 trillion by the end of 2023. So it really doesn't, it sounds like a lot, but because of the roll-offs that happen in the balance sheet, it's not really going to reduce the balance sheet that much. So, there's a lot of angst in the market about what this tapering is going to do, but it's not really kind of as big as you think. The other side of this coin also is that, as the Fed is looking forward, Neil Kashkari was out today saying that he thinks the Fed can only get to about 2%, which is the neutral rate. Now, that's about 1.5 points lower than what the Fed funds rate thinks it's going to be. So, there's a kind of, two schools here, and this is more in line with what you and I have been talking about, is that I think there's a lot less room for the Fed to hike rates. And what the Fed's really hoping for, to your point, is that the economy and the markets are going to do the work for the Fed, so they don't have to hike as much. They're wanting the stock market to come down. They want the housing market to come down. They want the economy to slow down, which will quell inflation. So they're okay with letting that happen for now, because it's all been pretty controlled up to this point. When it gets uncontrolled, that's going to be where they really run into a problem. And that could happen at another 50 basis point hike or one after that. But you're going to pop something in the market. I don't know when it's going to be, but that's when you get that uncontrolled event in the market that causes that kind of, oh darn moment for the Fed, and they start trying to reverse course.
All right. And what is interesting is we are now, I think, beginning to see some signs of demand destruction. I think we're early in here, right? And whether the demand destruction is caused by the high prices that inflation's resulted in, or whether it's the yields have come up and things are just getting more expensive, and the Fed's jawboning and all that stuff. I can't say for sure which one it is, but we are actually beginning to see some important initial signs. I'm going to share a tweet here real quickly. This is from an account car dealership guy, but this is a guy who works at a car dealership, and he just sort of shares in real time, what he's seeing. His latest tweet here says the Manheim Used Car Index just recorded its largest 90-day decline in history, 6.6% since January. Another tweet, every car dealer I'm speaking with is slow, like really slow. Seems like the CarMax Carvana earnings may have been the canary in the coal mine. So, we've remarked over past videos that, over the past 2 years, auto prices went bananas, ballistic, for two reasons. One, supply chain shortages dramatically reduced the number of microchips that were available to make cars. Cars require a gazillion different microchips from a gazillion different suppliers. And so new car inventory, new car supply dried up. And so everybody, when they started getting their stimulus checks and whatnot and needed a car, they went into the used car market and drove those prices bananas. I think everybody's heard the stories of people whose cars were like, 7 years old, and their resale price of that 7-year-old car was higher than the MSRP when they actually bought the car new, right? So it looks like we are now beginning to see some moderation there. We're also beginning to see some early signs in the housing market. Redfin has announced that they're beginning to see some price declines, more price declines than they've seen in a long time in a number of the hotter markets here. It's not a full-blown rollover yet, but they're beginning to see those initial signs. And Zillow stock plunged 9% yesterday after hours because the executive said, quote, one thing that is clear about the 2022 housing market is that the path ahead is uncertain. And I got to tell you, that is a complete 180 degrees from where those guys were talking, just a couple quarters ago. Yeah. So all of a sudden, housing, which was this unstoppable juggernaut, now that it's slammed into 5+%, 30-year fixed mortgages, almost a doubling since last summer, we're really beginning to see, uncertainty, which of course is the prelude to anxiety in that market. So I'll stop talking here, Lance, but we are beginning to see that, the raging, demand of the past couple of years, maybe shifting into reverse here.
Yeah, I think it's funny too, because, if you look at the real estate market in particular, Redfin, Open Door, Zillow Group, this was the new evolution of housing. Housing was never going to be the same again because we're going to do it all online and we're going to do, all this activity. And Zillow gets into buying houses and they're going to just be the intermediary between the buyer and the seller and flip these homes. And of course, is always the case when you start seeing companies get into areas of the market they shouldn't get into. It's almost always an indication that you're near a peak of some sort and bad outcomes always happen. I'm just writing an article about SPACs. And, remember in 2020, 2021, we had a record issuance of SPACs, which are these special purpose acquisition companies that basically took in they're called blank check companies. Investors gave them
give me
capital.
The money and maybe I'll figure out what to do with it.
Exactly. Yeah. There's like 950 of them that still don't have a target that they took in all this money from investors, and they've got nothing to buy with it. And now you don't want to buy anything because everything you buy is basically getting trashed. But this is just that hallmark epitome of market fervor and speculative activity where people are just literally writing blank checks to stuff that they don't even know anything about. But hey, why not? Everything's going up. How can I lose? It's a no lose market. And it was funny because retail investors were going, oh, I got Wall Street by the tail now. These Robinhood Wall Street bet guys, they're like, we're going to take advantage of Wall Street. And for the first time, the retail traders gonna rule the markets. And Wall Street was sitting back laughing their ass off going, yeah, here's some more SPAC for you. Just, all you want, give me the money, because they're the ones underwriting this. This is how they make money. And so Wall Street, as usual, wins the game. The retail trader takes it in the shorts. And, this is the problem with all of these theses and themes. Look, I like Kathy Wood. I think she's, great, but, her whole thesis behind her investments are flawed. They're based on this premise about innovation, but she's refusing to look at fundamentals, which is what drive companies long-term. And there's a big chunk of companies that likely in her portfolio are going to wind up worthless. Now there's a few gems in there that will probably come out and be worth a lot of money someday. But, the problem is that in these moments where you have a stimulus liquidity fueled market, everybody forgets about the fundamental value of markets and how they work. And I know that's boring old fuddy-duddy stuff, and you're probably an old baby boomer if you believe in that type of thing, but ultimately that's the way markets work, and we're coming back to that now.
All right, so you're making the key takeaway I want folks to take from all this, and I'm going to mention one more point before I hammer it home, which is if you look at consumer credit, I mentioned this in the video that I did a couple of weeks back on how the consumer is really beginning to tap out and get into trouble here. Yeah. I'll put up a link to that video for those who haven't watched it. It's short and sweet. It's about 12 minutes, but it's full of data. But the latest stats came out for last month, I believe. Consumer credit increased by 52 billion versus expectations of 25 billion. Mm-hmm. And the previous month it had been at 37.7 billion. So a pretty dramatic jump in consumer credit, and fast outpace, more than folks expected, and fast outpacing the previous period. It's another sign that people are basically, now that they've all the excess support they had during the pandemic that's now gone away is gone, and to keep things going, to keep making ends meet, they are just maxing out their credit cards here right now. So it's another Absolutely. Sort of late stage sign. So just to encapsulate what you said there, Lance, is we have had this massively fueled, we can call it a bubble, we can call it a stimulus, overdrive, whatever, but it's led us to these, it engendered a ton of speculation, a ton of euphoria, and it led us up to this peak. And now the supports have been removed, right? Mm-hmm. So what you and I are kind of talking about on a week-to-week basis here is we expect a repricing of that, right? Especially because the Fed is trying to dismantle the support that it's been providing. Mm-hmm. Now, the thesis is what we think is going to happen is it's going to fall faster and farther at some point than the Fed really intends. and you mentioned they've got pretty cruel tools. So they're then going to scramble to try to, undo things. But we're trying to get people to get prepared for that elevator drop, right? No matter what happens, whether it, we get the worst case scenario or the Fed pivots midway through and things start to rebound, there is going to be some sort of air pocket here that we want to make sure that folks are at least taking into consideration and trying to get as prudently positioned for as possible here. So I'll stop talking and let you jump in.
No, so a couple of things. One, real important is that, in the inflation we have today is not driven by organic activity. It is a monetary phenomenon. To your point, it is simply a function of all that liquidity that we shoved into the markets. And, free checks are not free. Unfortunately, you're now having the payback for those free checks. And so you got all this free money. That's great. You went out and spent it. Well, here's the payback for it. It's coming in the form of tax through inflation. And you're absolutely right, Adam. You take a look at consumer credit, sharp increases in that. And consumers aren't going onto credit to expand their spending. They are just trying to your point, they're just trying to keep ends meeting. And wages aren't going up. If you took a look at the employment report that was out on Friday as a good example of this, wages actually fell. Real disposable incomes are now negative, sharply negative over the course of the last year-over-year comparison. Real retail sales are falling because we're not buying more volume of retail sales. We're just paying more for the same amount of volume. So when you start taking a look at all these impacts, that is all demand destruction. And well, I guess we're going to talk about inflation here in a second, but this is kind of leading us up to that conversation, is that demand destruction is a very disinflationary event. And I know that everybody's got this view in the world that, we're just going to have this continued runaway inflation of 10, 11, 12, 13, 15%. It's the 70s reborn again. We just don't have the economic support to run that type of inflation. People are talking about, interest rates on 10-year treasuries are going to go to 5%, 6%, 8% on 10-year treasuries. Can't. Too much leverage in the economy. Too much overhang in terms of debt through households. Credit card interest payments go up. Consumers can't make those payments. They've got to start cutting back dramatically at that point. And you begin to see retail demand. 70% of GDP is consumption. You start seeing that real demand destruction of the economy. That's a very disinflationary, deflationary event. Prices come down, interest rates will fall, and the Fed's going to be trying to figure a way out of their problem they've created. But that's just the eventual outcome of all of this. And again, look, bonds have been under a tremendous amount of pressure. We've talked about this just about every week, but bonds are still under a lot of pressure. Interest rates hit about 3.1% today. We are 4 standard deviations above long-term monthly moving averages. We're at levels that we have never been to historically, going back to the 1950s. In terms of deviations from long-term means and interest rates, we're at the level that something historically has broken every single time, and rates tend to fall very quickly when that happens. So again, it could be this is monthly data. So again, it could be 3 months from now, it could be 4 months from now, it could be 5 months from now. On a chart, you won't be able to tell the difference because it's not a daily chart. But when you start seeing, long-term moving averages and deviations and overbought conditions and things that we have right now in the bond market, it is screaming that you've got a problem coming down the road economically. It's just a function of time till it gets here. And, the Fed's going to have a whole lot of problem when it happens.
Okay, great. And I want to talk more specifically about bonds in just a second, but you did a great job of delivering the punchline of what I was leading up to here, which is, this is probably going to be a little bit controversial for some folks, but I guess the message I think we're trying to convey to folks here is prepare for disinflation and then possibly deflation over the rest of this year. Right. And again, everyone right now is so understandably focused on inflation and is out of control and whatnot. But there's much going on kind of beneath the surface here that is going to create that elevator drop we talked about. And one important element, which is covered in that video I mentioned, you talked about how consumer spending drives 70% of the economy. That video I talked about the concept of debt saturation, which is the consumer takes on more debt up until the point where they cannot take on any more debt at all afterwards. They literally max out. So it's just like, spooning that sugar into your lemonade. is it dissolves, it dissolves, it dissolves. You hit the saturation point and bang, none of it dissolves anymore. So the spending can really just sort of stop on a dime, so to speak. And that can be, obviously would be incredibly deflationary. Watch the inflation numbers closely. We're going to do that. We're going to have the latest CPI number coming out this coming week. We'll see if we're vindicated as the guys who put their necks out and said, we think it's going to be a lower percentage than it was this previous month. We'll see. We could be wrong. I'm open to being wrong, but I don't think it's going to be many more months of increase if it is.
Right. Well, no, and I think, and 2 points, just real quick, because that's such an important point. And so many people, and I know we've talked about it here before on the show, but just to reiterate this, is that CPI is measured on a year-over-year basis. So when we see the print, this month, maybe not. Maybe this month we come in line with inflation estimates. It's possible because energy prices have remained high here for the last couple of months, and energy runs about a 3-month lag going into PCE. So when you start looking at inflation, it's possible this month that comparing to where we were in April of last year, that we were just starting to pull a positive number in April of last year. So it's still very possible that inflation might print a little bit higher this month. It's not going to be like 1% higher, right? It may be 0.1% higher. It might be slightly higher. It might be in line. There's a real possibility, Adam. You're absolutely right. It might come in like 0.1% lower. But as we get into the May's number, June's number, July's number, we're comparing on a year-over-year basis, and those back-end numbers are starting to rise dramatically. So just think about where we are next year at this time. We're comparing to 8 and 9% growth rates on inflation. So just mathematically speaking, and this is the hard thing for people to understand, because they go to the gas pump and they're going, damn it, the gas is still $4 a gallon. How come you're telling me there's disinflation in the economy? It's because of the way we measure inflation. It doesn't mean your prices go down. It means that the comparison rate is going down, and that's disinflationary.
Exactly. Just to beat this dead horse, when we talk about CPI coming down, we don't necessarily mean prices coming down. We just mean the rate of increase. Right. Exactly. Big difference. All right. So sorry to speak quickly, but I'm just trying to bang a lot of the stuff out because I see we're going to get near the hour. I know we're going to go beyond it. I just don't want to go egregiously beyond it, like we're always guilty of. So bonds, TLT, we get asked about it all the time because we've talked about it a lot. I definitely seen a bunch of questions on YouTube. I'm sure you're getting questions from clients. So let's just talk about what happened this week. So the 10-year bond went up to 3.1, like you said. Right? I think it's the highest it's been this year so far, if I'm not mistaken.
Been the highest level since 2018.
All right, so since 2018. Okay. So yields go up, prices go down, right? So I think last time I saw it a few hours ago, this is pretty close to the close. TLT was trading at like 114. I can't remember what it started the year at like maybe in the 150s or something like that. So it's been a sort of a steady escalator down. I'm sure that a lot of people saying, when is it going to end? What I heard you say earlier is, hey, nobody knows for sure. But if we look at, historical technicals, this thing is going back to your rubber band analogy. This band is ridiculously stretched here.
We've had the largest drawdown in bonds since 1778. And the point about that is that we've had periods in history where you've had very large drawdowns in both equities and in bonds. And if I was telling you right now that the equity market was down 50% and I wanted you to go in and start buying stocks like crazy, everybody would be telling you, are you nuts? This market's going to zero. But, when you have, major drawdowns in asset classes, that's generally the time you want to be a buyer. But it's very difficult because in psychology, we believe it's just going to keep going down. It's just never, ever going to go up again. And that's always the problem with investing. And bonds right now are in essentially a 50% bear market drawdown for equities. I mean, on a relative basis, it's one of the largest drawdowns in the history of bond markets. And every single time in history, the subsequent year was a very large increase for bonds. And that's because generally you're going to bust something in the market because interest rates are going up, bond prices are going down. And remember, there's a fundamental. I get a lot of questions. It's like, well, Lance, you do such a good job of taking profits and cutting losers short in equities. Why are you still sitting on these bond positions? And the reason is that I've got two things that are going on with our bond position. First of all, there's a longer term thesis. We're not trading bonds short term. We've got a thesis in place in our portfolio as a hedge against equity market risk. Adam, you were just talking about a second. What happens if that gap opens up in the markets and stocks fall by 20%? Where's money going to go? It's going to go into treasuries. So as a hedge against a big gap open in the market, we own bonds for that hedge. If I'm short the market, and let's put it in equity terms, let's say that I'm long stocks and I'm shorting the market to hedge against my long position and stocks are still going up. What's happening to my short position? What's happening to my hedge? It's going down in value, but my long positions are still making me money. That's okay. And like I said earlier, right now our portfolio is beating our benchmark by about 500 basis points because of both our equity strategy, our exposure to cash, and our hedges with bonds. Those are all playing their important part of managing that portfolio return. So the point here is simply this, is that a hedge doesn't necessarily work well when markets are doing what they're supposed to be doing. And right now we've got a very interesting situation going on because bonds and stocks are highly correlated. That only happens typically for a very short time in the markets. Those correlations between stocks and bonds, when they're positively correlated, don't last very long. So again, we've got a position in TLT in our portfolio to both hedge our portfolio in the event of something going wrong. But B, the longer term thesis is that the Fed's going to break something and interest rates are going to drop lower. And again, I'm on record saying this, and I'll say it again, is that my bet is that over the next 12 to 18 months, that bonds will outperform stocks in terms of total return.
All right. Well, we will be tracking that every week here on this program. So we'll see.
And of course it'll happen. Of course, that's going to happen 19 months from now, but there you go.
All right. Two quick things I want to get into, unless we stumble into one of our epic rants. Very quickly, I just want to ask the question about margin calls to see if that's something that you're worried about at all here. So getting back to at the beginning of the discussion, markets have come down. They're very, uncertain right now, and people have lost a fair amount of money. Funds have lost a fair amount of money in this process, especially if you've been in the, Cathie Wood type of companies and whatnot. Yeah. So there are these things called margin calls, where if you've been trading on margin, where, a fair amount of investors do, and up until relatively recently, margin debt was the highest it had ever been. When you have sudden surprising drawdowns, what can happen, or what often happens when there's a sharp surprising drawdown, is those investors get what are called margin calls, where they're told, hey, you've got to have enough capital in your account with us to cover your exposure here, because the security you bought on margin just dropped a lot, and if you don't give us that money fast, we're going to start selling your position to cover it, right? And so those margin calls can basically kind of add fuel to the a market drop fire, because either the exchange starts selling or the brokerage starts selling your position for you because you haven't given them more money, or you have to go out and sell something else, putting downward pressure on that asset to meet your margin calls here. So, sometimes what can happen is they can kind of create this cascading domino effect in asset prices. Given that we're kind of on the cusp of the, year lows and whatnot, and you talked about kind of, if we punch through them, there could be a pretty big air pocket below to 3,000. How worried are you about margin calls right here?
Very concerned. And so two things. One, about margin calls, it's all about math. So if I have $100 in my account and it's an equity, so let's say I own $100 worth of Apple. In most margin accounts, I can borrow, say, 50% of an equity like Apple. So I can leverage my account up to $150. So I can have 50% of, and we're just using round numbers. Margin levels changed with different firms and different stocks, but just simple math here. So let's say that I have a 50% margin line and max in my portfolio, and I've got $100 worth of Apple, and I go buy another $50 worth of Apple on margin. So now I've got $150 worth of Apple. Sounds great. So what that is, and to your point, the way margin works is that if Apple declines in value to the point that it triggers the requirements of the firm and whatever broker lent me the money on margin, it's a loan, whatever that is, there's a level to where that firm will then call me. And to your point, they'll say, okay, the stock has fallen from $100, it's now $90, and you can only have a 50% margin line. So a 50% margin line on $90 is only $45. So I've got to go sell. I've either got to put $5 in to the account, or I've got to go sell $5 worth of stock. Well, when I sell something, it now reduces that. So I have to sell $5 worth of Apple. Now I only have $85 worth of Apple, which means that my margin line is now only, $42.50. So, it's just as to your point, is that once the selling starts, it creates this frenzy because we're constantly knocking down the value, requiring more selling, which lowers the value of the margin limit, which requires more selling. And that's the real risk. Now, margin debt has been coming down from the peak because a lot of people were long margin in a lot of these meme stocks and Cathie Wood type stocks, et cetera. So we've seen margin debt increasing, but it's still at a higher level than we saw at any previous peak in the markets. I mean, the amount of leverage put in the markets over the last 5 years in particular has just been astronomical. So, but those levels are coming down, and the risk is always about 20%. And if you go back to March of 2020, when we got down about 20-25% on the market, now we were going down pretty quick in March of 2020, but when we hit that 20-25% level, that's where the Fed started reversing and started talking about setting up, bailouts and this type of thing. And, we're talking about bailing out corporations that, and lifelines, and the government was talking about, doing other stuff. But that's because we were right to that point. And that's where the Fed started buying junk bond ETFs and started buying bond ETFs. They were doing everything they could to keep those margin lines from completely blowing apart, because that's the big risk, is that if you bust those margin lines, I wrote about this a few years ago, those margin lines are like a tanker of gasoline, right? I mean, we're not talking a bucket of gasoline. We're talking like a tanker of gasoline. And all it requires is a spark to ignite that. And again, if you start busting those levels where you start getting accelerated selling and these brokerage firms start really worrying about the ability of people to meet margin demand, they're all going to call up and say, Adam, you need to cover your margin line by 3:00 this afternoon. If you don't, we're going to liquidate your account. And that's the problem with margin that people don't understand when they get into it. They go, oh yeah, I'll borrow on it. And, if everything goes, if anything goes wrong, I'll just cover it. It's not at your discretion to cover that line. It's at the broker dealer's discretion. And they call you up and say, either you pay or we liquidate by 3:00 today. It's not, they're not going to give you a month to come up with the money to cover that line. You're going to do it today or we'll do it for you. It's not at your discretion. And that's the risk to the markets. When those lines go, it goes right across the market.
All right. Well, maybe we should have stumbled into our topic of outrage. We don't need to spend a ton of time on it, but a question for you, Lance. So it sounds like we learned nothing from the 2008 crisis when it came to margin debt, correct?
We learned nothing from the 2008 crisis, period.
I know we could say that basically on everything.
Yeah. And the reason I say that, again, I was talking to.
But wait, hey, we learned how to paper over our problems for 10 years.
We did. No, but I was talking to a guy the other day, and super nice guy. He's young. He's about 35 years old. And, he reads a lot of the kind of the mainstream kind of retail, media. Right. And I won't mention any names. And he was naming off some of the guys that he follows. And, he was debating me on, really, we're talking about passive investing and buy and hold investing versus active. And his whole premise was, active investing always underperforms markets over time. You should just passive index. I'm like, yeah. Gotcha. Been there, done that. Here's the problem. everybody he's following and reading about this passive investing, they didn't even start investing in the markets till 2010, 2011. They've never been through a bear market.
Yeah. All they know is the tailwind backstop by the Fed. Yeah.
Yeah. And so buy and hold is, yeah, you know what? 2010, 11, 12, 13, 14, 15, buy and hold because it worked. Right. And look, and buy and hold still works today, right? We're still not in a bear market, right? We haven't done that. I'm doing a chart in this weekend's newsletter just saying, where's the bottom? And I've got a monthly chart that is looking at the 34-month moving average. So roughly 3 years. And using that as kind of a bullish trend line. So if you're just looking at, kind of where was the bullish trend line in the markets going back to 1990, a 34-month moving average gives you a pretty decent level that every time the market came down and touched that moving average, that was the bottom of the correction and it took off. Now, if you violated that correction of that level, and you've only done that twice since 1990, I'll let you guess when those 2 points were. Then it went to a standard deviation below that level, 2000, 2008, obviously. And you take a look at the monthly RSI index, which it's a relative strength index. The only 2 times since 1990 that the relative strength index went from above 80 to below 20 was during the 2 bear markets of 2000 and 2008. Every other time that you had even a sizable correction, and this includes the corrections of March 2020, mind you, which everybody called the bear market. It wasn't. It was a correction because you only touched the bullish trend line and the relative strength index never got below 50. And so for all intents and purposes, that was a bull market correction. We are still in a bull market. We have not entered into a bear market because we're still above that 34-week moving average. To get to that 34-week moving average, we need another 22% to the downside, just to put it into perspective. A 50% Fibonacci correction from the 2009 bear market bottom would require a decline of 44% from the peak. That puts you back around 3,000 on the index or so. So look, I mean, there's certainly some downside risk here, but when we're talking about bull markets and bear markets, the buy and hold mantra right now still seems to be working because we're still in technically a bull market. It certainly doesn't feel that way. And unfortunately, these kind of buy and hold investors and that idea, they're not going to come to that rude awakening until we're down that extra 22%. Then all of a sudden, they're going to start to question the reality of what just happened to about 5 years worth of their gains in their portfolio. At 44% down, we're now going to be back to 2015, where I just lost 7 years of returns out of my portfolios. That's the damage that buy and hold investing will ultimately inflict on investors.
Yeah. And of course, you're just talking about buy and hold investing of the indices. There have been people, as you've said, you look at the NASDAQ for sure. A lot of companies in there have had massive corrections, this year. So it could get worse if the industry continues going down. All right, look, I've got 2 last things I want to try to squeeze in here before we wrap things up. The first one, important, which is what trades, if any, have you made since last week and why?
So 2 trades we made this week. In our equity model, we bought a little bit of Verizon because it's got a 5.5% dividend yield. Fundamentals look pretty good. Stock's been beaten to death here lately. And so we're looking to add a little bit of the value story into our portfolio. Again, if we do have more of a decline, value tends to outperform better than growth will. And of course, we talked about previously that we reduced.
And you get paid for holding it too.
And you get paid for holding it. And we talked about previously, we reduced a lot of our technology growth exposure. We still own the ones we like. Portions of them. We own very small amounts of them, and we're looking for a point to add to those exposures at when we start seeing the disinflationary trends in the market, which will be good for growth stocks. We also added to our position in public storage, PSA, And the reason for that is we had sold it previously and taken profits out of it, reduced our position size, and the stock's had a fairly big correction here over the last really the last month because of this market sell-off. It's really been pretty broad. It's pretty much hit everything to a large degree. So PSA had a very, very big decline. And the thesis behind that is if we do get into a economic slowdown, issue in the economy and people start getting evicted out of their homes, there's two things that people will pay for regardless. Actually, let me say three things. There's three things that people will pay for regardless of what's going on in the economy. They're going to pay for food, they're going to pay for gasoline, and they're going to pay for someplace to store all their crap. And that's a storage unit. So, if you get kicked out of your house because you can't afford the payment, you're in an apartment, you're storing your stuff in a storage bin. And look, we, Americans, we like our stuff, and people have storage units. And if you don't pay the bill, you lose all your stuff. So people will pay that bill regardless of what's going on. So in the real estate space, that's one of our favorite holdings.
Okay. And I'm just going to ask the TLT question again, because it's been so frequent here. You holding, adding, selling here?
Holding right now. Now we have a model that we run called a platinum model, which is for our high net worth family offices, those type of things. And we've actually been writing out of the money puts on TLT at much lower levels and getting paid because there's so much volatility. We were writing some options here over the last couple of days, getting paid $3, $4, $5 for them. So we're doing that in that model. The kind of our standard equity.
Sorry to interrupt, but just for the people watching who don't understand what writing a put means, it's using options. But the thing to take away from it is you write a put when you expect the price to go up.
Yeah, exactly. Well, actually, in this case, what I'm doing is I'm writing a put, which is paying me right now. Say I get paid, let's just use some simple numbers on TLT. Let's say TLT's at 114 and I write a 113 put and I get paid $1 for it. So I get paid today $1 for that put. And if TLT falls to 113 or below it, whoever owned TLT on that other side of that contract can put their TLT position to me. Now, I'm happy to buy it at 113, but I get it at 113 plus $1. So, that just kind of gives some income to portfolios right now and lets me buy stuff at a lower level if it gets there, which may or may not happen because I'm writing these puts actually below into 4 standard deviation territory.
Right. But you're even happier if we're in 4 standard deviation territory, the TLT moves back up from here. So you've been paid to write the put and your underlying positions in TLT are doing great.
Exactly. Because then I just keep the cash and I don't I just go from there.
You get the appreciation and the cash. It's a nice deal.
Exactly. Can't beat that. But in our other portfolios, our equity models and our ETF models, no, we're not adding just yet. We are lining up to add to that position. Now we have several different positions. When we're talking about our bond portfolio, we have a position in TLT, but we also own, some position in shorter bonds, also floaters, a variety of floating rate treasuries, et cetera. So we have a lot of stuff stacked up on the real short end of the curve as well. And what we'll do is shift that short end of the curve to TLT. So we'll increase our TLT position size by reducing our short end, increasing that duration in our bond portfolio. And we'll do that. What we're looking for is and we're getting close, but a lot of our metrics, our longer term MACD signals, our longer term RSI signals, et cetera, they're not on buy signals yet. So we're looking for those to give us buy signals, CTLT base here a little bit, and give us a little bit of a positive upswing. We'll have plenty of time to start building that position and adding to it as rates start to come down. So we're not in a hurry. We're just kind of biding our time. And, we're just going to let the position come to us.
All right, great. All right. Well, look, in wrapping up here, I want to just introduce a concept here that we can hopefully explore in future videos, Lance. And I'm springing this on you, so folks know that Lance hasn't even heard this from me yet. But, we spend an awful lot of time on this program, and I do on Wealthion with the guests that I interview, every day during the week, is warning people about the potential for, these unsustainable trends that we talk about in the macro side of things, really beginning to kind of materialize in force, right? So it's fairly, called, we're on the bearish side, at least we're on the skeptical side of the status quo, right? And I think because I cover that content, the type of content so frequently, people will call me a perma bear or think that I like to be talking about these negative things. Yeah, you're raising your hand, Lance. I've heard you call me that before.
No, I'm not calling. No, people call me perma bear.
I know they call you the same thing too.
Yeah, I've been a perma bear forever, right? So yeah.
Okay, but where I'm going with this is I think we would much rather talk about the great opportunities out there to invest in, right? We're just calling it as we see it, and we happen to be in the place of the macro timeline where calling it as we see it, say, hey, we still think things are pretty overvalued here. We still think there's a lot of structural instability that could bite us here. So it's a time where we're kind of warning for caution. Now, I'm really looking forward to the time where either fundamentals increase in the economy, or we have prices correct down to a point where there's true value to be had, and more the conversation could be more about, hey, we think there's some deep value here you should look at, right? So I just want to share this one tweet that was brought to my attention there, one chart. It's talking about the NASDAQ biotech sector. And it says that, I'm just going to read it here. An unprecedented number of biotech firms are underwater right now. More than 20% of the NASDAQ biotechnology indexes, 370 members, are trading for less than cash. There's never been anything like this in the data going back to 2022. The companies have about $20 billion worth of cash, but are worth only $11 billion. So, Lance, I haven't spent the time to really dig under this initial tweet, but it catches my attention, right? Mm-hmm. All right, you've got this sector that's basically selling for almost 50% less than just the cash balances on these companies. I don't know if this is, there may be some extenuating factors here that totally justify that discount. Who knows? But to me, that's sort of an example of like, hey, as prices begin to come down like this, as sectors begin to get wiped out, you may actually be able to really get your hands on some long-term great value at great prices. So anyways, I just want to sort of note that to say that I'm looking forward to the time, Lance, where we can spend a fair amount of these conversations kind of sharing where we're finding deep value in the markets. And we're not finding it lots of places yet, but this might be one to dig into.
No, absolutely. Look, and what you're talking about is exactly what Elon Musk and Cathie Wood were talking about this past week in terms of passive investing. And, they said like the problem with passive investing is that it covers up these opportunities. The reason that you have going on, what you have happening in the biotech index right now, is there's a lot of great companies in there that are unfairly beaten up. And it's not just the biotech index, it's across the market, right? There are some really good companies that have been really taken out to the woodshed. And it's not because there's something wrong with those companies. It's because of individuals dumping ETFs and selling ETFs. And again, we talked about the whole passive indexing effect across the whole market. So, look, Cathie Wood's ARK ETF is an example where I'm not picking on her. It's just she's a great example for one area of the market. And so if she hears the interview, I'm not picking on you. I think you're great. But, the point is that if she's had a lot of redemptions. And so when people start redeeming that ARK ETF, it starts to sell Teladoc and Zoom and Peloton and Tesla and, all these other companies that she owns. She's got to sell those because they're redeeming that ETF. And so multiply that out there by all the ETFs. We have thousands upon thousands of ETFs now in the market. They all own the same shares. We've talked about before on the show, 333 some odd companies all own Apple, right? So, you're getting these diversions from fair value caused by the pressure, both up and down, of this ETF buying or selling frenzy that we have going on. And again, so this is why, when we're picking stocks for our equity portfolio, we run an ETF portfolio also, but in our equity portfolio, we're having to really dig through there and look for things that have been what we feel like are unfairly beaten down, or near lows that we think can hold. And then we ease into them just a little bit at a time and try to allow that position to mature so we can add to it over time. And that's, that's the challenging part, because you got to be patient. And the problem is in this market is that nobody has patience anymore. It's like, if I buy it today and it doesn't go up, I got to sell it. And that's not the way investing works.
You're right. You're right. Yeah. It's the ADD market, right? That's what we're
exactly.
All right. Well, look, for the folks that ping me in the comments and say, hey, Adam, why are you worried about keeping these things, from going too long? We want you and Lance to go to 2 hours, 3 hours.
No.
Yeah, I know. But you got your fill today. We did run over as usual. Lance has made, I think, it's several points throughout this conversation. I think did a great job of emphasizing the point of, look, don't let your emotions control you. Put together a plan. If you want to talk to an advisor who gets the type of concepts that we've been talking about here, if you want to talk to Lance's firm specifically, just go to wealthion.com, fill out the form there. We'll connect you with them. Real quickly too, I've been getting a lot of people from these videos beginning to start following me on Twitter. If you haven't yet and you want to, feel free to do so. My Twitter handle is @MenloBear. That's where I'm posting updates throughout the day of interesting data I find, like that tweet I just talked about with the biotech stocks. So if you kind of want to get commentary throughout the day, that's a fun way to do it if you don't want to wait just for our next video to come out. Lance, as always, buddy, it's been great talking with you. Have yourself a great weekend. Recharge your batteries. Something tells me that next week is going to be keeping you pretty busy too. But whatever does happen, we'll be tracking it here together on this program. Thanks again for joining, Lance. Everybody else, thanks so much for watching.